In 1800, if you wanted a piece of most businesses, you needed more than money. You needed proximity, a handshake, a family name, trust built face to face. Today, an eligible investor thousands of miles from New York can tap a phone and buy $10 of an American company, or in some markets, a digital token representing a claim on one. But the remarkable part is not the phone. It is the sequence of barriers that had to disappear before that tap became possible. This is not primarily a crypto story. It is a 200-year story about America turning ownership into something the world could increasingly reach. In 1792, 24 New York brokers signed the Buttonwood Agreement. It did not create global investing. It created rules. Buyers and sellers could trade inside an organized system and trust the other side to honor the deal. Ownership was becoming transferable. Then railroads sold shares to finance tracks across a continent. Telegraph wires carried prices farther and faster. In 1867, the stock ticker began sending market information beyond the trading floor. Distance was weakening, but access still belonged largely to people with wealth, connections, and a broker. Then history accelerated. After the Second World War, Europe and Japan were rebuilding, while the United States held extraordinary industrial power and most of the world's official gold reserves. At Bretton Woods, currencies were tied to the dollar, and the dollar to gold. The dollar became the central bridge of the post-war monetary system. Even after the gold link ended in 1971, the dollar remained embedded in trade, banking, debt, and the world's deepest capital markets. Global investors did not only want dollars, they wanted what dollars could buy: American government debt, American companies, American growth. In 1790, global brokerage networks removed another barrier. A foreign investor no longer needed to stand near Wall Street. They needed an account, the required documents, legal permission, and a connection. The internet brought the market onto ordinary screens. Smartphones pushed it into a pocket. Fractional shares weakened the price barrier. A company could trade at hundreds or thousands of dollars per share, yet $10 could still buy a fraction. Ownership had moved from the private room to the exchange floor, to the computer, to the phone, and now it may be moving again. Tokenization represents a claim on an asset, a share, a bond, a treasury fund, as a digital token on a blockchain. In theory, it can trade continuously and settle quickly. In early 2026, the parent of the New York Stock Exchange said it had developed a platform for round-the-clock trading and on-chain settlement of tokenized securities using dollar-sized orders and stablecoin funding, subject to regulatory approval. And this is where the story changes. The asset may be American, but so is often the money used to reach it. Most stablecoin value is linked to the US dollar. Major issuers commonly hold cash, treasury bills, and similar short-term assets behind those digital dollars. Imagine an eligible user far from the United States. They may not earn an American salary or hold an American bank account. Yet where local rules permit, they may hold a dollar stablecoin, access a tokenized treasury product, or gain exposure to an American company. One phone, multiple layers of dollar demand. The payment unit is dollars. The reserves may include US government debt. The investment may be an American security. This does not guarantee a new era of dollar dominance, but it suggests something important. The dollar may not merely travel across the internet. It may become part of the internet's financial plumbing. A historian must interrupt here. This was not one continuous American master plan. The brokers of 1792 did not imagine blockchains. The architects of Bretton Woods did not design stablecoins. Each generation solved the problem in front of it. The larger pattern emerged afterward. Tokenized markets also remain small beside conventional stocks and bonds. A digital token does not erase identity checks, sanctions, securities laws. custody failures, cyber risk, or national restrictions. And a tokenized claim is only as strong as the issuer, the custodian, the legal rights, and the asset behind it. Other systems will respond. Technology alone cannot guarantee trust. Still, look at the distance ownership has traveled, from signatures inside private rooms, to prices shouted across trading floors, to markets glowing on billions of screens. For 2 centuries, each new system removed a barrier: trust, distance, access, price, and perhaps now, infrastructure itself. Subscribe for more stories about the hidden systems shaping history. Because the next chapter of dollar power may not be printed on paper, it may be written into the rails through which the internet learns to own.